Hello everyone, welcome to Wikilove Learning videos once again. In this learning objective, we discuss some of the risks associated with international investing. While international investing has the diversification benefits that can be achieved by investing across countries where the correlation coefficient is less than 1, there are also additional risk factors that investors must consider when they decide to invest globally. These additional risk factors include liquidity risk, information asymmetries, foreign exchange risk, and country risk. Liquidity risk is the idea that if you are investing from a perspective of a developed country and you decide to, for example, invest in an emerging market, many of the emerging markets might have a lower level of liquidity compared with the liquidity of a developed market. In that instance, when you go about investing in these global markets, you might find that your risk exposure increases due to that lower level of liquidity. Information asymmetry is due to the fact that when you invest internationally, less information might be available, or it might be more difficult to go about accessing that information about a particular stock that you are investing in. Therefore, it creates an additional level of risk for the investors because of that lack or difficulty to obtain information. However, the two key aspects that we are going to focus on this learning objective are foreign exchange risk and country risk. So when we go about investing internationally, what we typically do is we convert home currency into foreign currency and then use that foreign currency to invest in a foreign country. And once the return is generated in foreign currency, that is then again converted back to home currency. Therefore, the total return that we earn on our investment is the investment return that generated within the foreign currency plus the return that we get on foreign exchange rate changes. Now, because we are adding that additional layer of return on foreign exchange, which can be positive or negative, what we are really doing is we are adding a degree of uncertainty or adding a degree of risk around our total return. It's important to note that it's often difficult, if not impossible, to completely hedge a foreign exchange risk. So this risk is always going to be there in some capacity. So let's see an example. As I already have said that let's say an US investor is investing in Australian market. So the US investor's return will have two components. One is return in the foreign market, I mean return that is generated in Australian market, and the return that is generated due to the change in foreign exchange rates. Let's say this is a particular period of the year 2009 and the exchange rate between Australian dollar and US dollar in the December 2008 is 0.6972. It means that one Australian dollar can buy 0.6972 US dollar. And at the end of 29, the exchange rate becomes 0.8994. So now one Australian dollar can buy 0.8994 US dollars. So you can see that Australian dollar has appreciated to a large extent. And these are the market index, all ordinary index. And at the end of 28, it's 24,000. At the end of 29, it is 33,698. Now, as an US investor invests in Australian market, the US investor first will generate a return based on the difference between these US market prices. The Australian market prices. Then the US investor will generate an additional return for the change in exchange rates. Let's say that US investor start with an amount of 1 million US dollar to invest. So now this US dollar, first of all, will be converted into Australian dollar using the spot rate that was at the end of 2008, 0.6972. So using this spot rate, US dollar is converted into Australian dollar. So US investor get 1,434,000 Australian dollar. Now this amount is invested in the Australian market, and you can remember the change in the Australian market prices indicates that the US investor can generate a 39.58% return in the local currency. I mean the return in the Australian dollar. So the invested 1.434 million Australian dollar is converted into 2 million Australian dollar at the end of the year. Now this Australian dollar will be converted back to US dollar using the end of the period spot rate, which was 0.8994. So using this spot rate, this 2 million Australian dollar is converted back to US dollar, and the US investor will get 1.8 million US dollar against an investment of 1 million US dollar. So the total return to US investor is about 80%. So you can see that although US investor earns about 40% return in Australian dollar, the return is effectively 80% after considering the exchange rate return. And probably you understand that this the huge return was possible to generate since the Australian dollar appreciated. So a general rule is that if you invest in a foreign currency and your investment denominating that currency appreciates against your domestic currency, your return will be magnified. However, the other side of the coin is if this Australian dollar would have depreciated against US dollar, then your return in US dollar would have been lower than the return you earn in Australian dollar. Now, not only Australian dollar appreciated against the US dollar, you can see that many other currencies were appreciated against US dollar, or US dollar depreciated against the many currencies. So for all these currencies, for example, you can see Australia, it's about 80% that we have seen in the last slide. And also you can see for Norway, it's a 88.6%. So what's happening is the black line here is the return of US investors that they got on foreign markets. That was the return on the stock exchange within that particular market. For example, in Australia, the Australian market went up by 37%. And then the blue line is basically the combination of the return and the exchange rate variation. Now we can see that fluctuation in exchange rate can have a significant effect on the returns that are generated by an investor. Now, this risk exposure is particularly pertinent if an investor is not able to predict future currency movement and if foreign exchange is relatively volatile. If you look at here, this is the time trend of the exchange rate between Australian dollar and US dollar. You can see this period where you have a flat line indicating the fixed exchange rate when Australian dollar used to be pegged against the US dollar. However, after that, you can see a significant volatility in the exchange rate between Australian dollar and US dollar. So you can see during this time period, you could use 1 Australian dollar to buy about 1.5 US dollar. However, in October 2000, using 1 Australian dollar, you could buy only 0.5 US dollar. So you can see that if you cannot reasonably predict exchange rate movement, that can be a substantial risk for you if you decide to go investing in an internationally diversified portfolio. Now, the second key factor is to consider the country risk. The country risk is the risk of investing in a country that's depend on changes in the business environment that might have an adverse effect on company profitability within that country and hence have a slowdown effect on the investment returns that are generated within that country. So if we are thinking about investing internationally, we want to get a measure of the degree of risk in that particular country that we are considering investing. There is a couple of ways this can be measured. One way is by looking at sovereign the credit default swap spread. A credit default swap is a financial asset. It's a security that pays out in the event of a default on particular company or particular country. So higher the probability of default, higher will be the level of credit default swap spread. So when we talk about a sovereign credit default swap, that's a security that pays out where there is a probability of default in a particular country or government through time. So we can use the spread on credit default swap to measure the probability of default. So higher the sovereign credit default swap spread for a country may indicate higher level of country risk. Alternatively, analysts also provide various country-specific risk measures. For example, I have got here a world map that's provided by Euromoney data, and you can see that they have color-coded the risk around the world, where the country like Australia and the US consider to be quite safe. However, some African countries have a quite large amount of risk. Similarly, some Asian countries and the Middle Eastern countries across here, we can see have a sort of elevated level of risk. Now let's see more detail about the sovereign credit default swap spreads of some countries during the GFC. So these are the credit default swap spreads between the 2007-2008 period for some industrially developed countries, for example, United States, Germany, Italy, Greece, UK, Netherlands, Spain, and Portugal. You can see in general for all these countries, this credit default swap spread increased during the global financial crisis period, indicating the probability of default risk for all this country increase. I mean, the general country risk increased during this period. However, for countries particularly like Greece and Portugal, the credit default swap spread was much higher compared to some other countries which is considered to be relatively safe, for example, United States, United Kingdom, and Germany. So you can see that credit default swap spread can be a reasonably good measure of the country risk in different time periods. One alternative way of trying to measure the level of country risk is the use of some analyst service. One example of this is the PRS group. The PRS group provide political risk measurement services whereby they give a quantitative measure of the level of risk across a range of categories for a particular country, and then they combine those quantitative measures together to give a composite risk index that basically ranges from very high risk to very low risk, and it can be used by investors to help make an informed decision. So here you can see that the PRS group divide the country risk in three major categories. For example, political risk, financial risk, and economic risk. And under each of these risk categories, they consider a range of variables. So by looking at these variables, you will understand that how they measure country risk. For example, as far as political risk is concerned, they consider government stability, socioeconomic condition, investment profile, internal conflicts, corruption, military in politics, religious tension, ethnic tension, democratic accountability, bureaucracy quality, and so on. For financial risk, they look at different economic indicators, for example, foreign debt as a percent of GDP, foreign debt service as a percentage of GDP, current account percentage of exports, net liquidity, exchange rate stability. In terms of economic risk, they look at GDP per capita, real annual GDP growth rate, annual inflation rate, the budget balance, and current account balance. So what they actually do is they provide a score for each of these factors under each of these risk categories. So by combining all these score, they will get a score, I mean a composite score for political risk, a composite score for financial risk, a composite for economic risk. And finally, by combining all these factors, they will get a grand score for the country risk, which will range from very low risk to high risk. So this is just an example of an organization that provides a measure of country risk, but basically it's demonstrating how the country risk can be measured for an investor to incorporate this in internationally diversified portfolio decision. That's the end of our discussion on this learning objective. Thank you.